All right, we are here for another episode of Millennial Money Matters with Kelly Turner.
And Derek Mazzarella.
And what are we talking about today, Derek?
We are going to talk about interest rates and the Federal Reserve, everyone's favorite topic.
The Fed. So
The Fed.
If you did not know, mortgage loan officers, everyone in the mortgage industry loves nothing more than to talk about our favorite guy, Jerome Powell.
JP, huh?
We love him by that, not so much. We love him sometimes when he's helpful for us, and we dislike him others when he's not. So it's really like a little bit of a love-hate relationship.
I can see that. I mean, I'm sure everyone just automatically assumes like whatever he does it instantly goes into mortgages, right?
100%. I cannot tell you how many phone calls I have gotten since that Fed meeting telling me, oh, interest rates are in the 4s. I'm ready to refi.
Let's do it.
Let's do it.
Well, why don't we backtrack a little bit, because we're going to talk about the mortgages and how everything's impacted by that. But I think it's helpful to understand, okay, like who's the Fed? What do they actually do? What are their tools? So why don't we just get into it? So the Federal Reserve,
Who are they?
often called the Fed to be cool. Basically, they have two jobs. They want to keep unemployment low, so they want to make sure people have jobs, right? And they also want to tame inflation, so they don't want inflation to run crazy.
Mm-hmm.
That's it.
We did a poor job at that for a couple of years.
Yeah, I would say that some on the Fed, some on us giving everyone a ton of money and just saying, don't worry about it.
Don't worry about it.
Don't worry about it.
Here's your free money.
This is a loan, quote unquote, that you never have to pay back. Great.
Correct.
I'll take all that
The
money.
best kind of loan there is.
Yeah. Even rich people got it, so it's great. So their dual mandate is tough because they really only have two tools, right? They have interest rates they can manipulate, or they have something called quantitative easing.
Yes, which whenever people use that term or people see it, they're like, it sounds like a science experiment. It's totally, what is quantitative easing?
It sounds like really cool, really important, but all it really is they just buy bonds. They just buy a ton of treasuries. They just want to give extra money to banks so banks have more money to loan. So we're not going to talk about that today. It's just one of their other tools. We're going to talk about the interest rates. So basically, what the interest rates theory behind that is, it's, you kind of use the break analogy before. I don't know if you want me to use the cone one I use. It's either one, but
I'll use my break one.
Go for the break one. Okay.
So this is sort of an analogy of what the Fed is doing. The U.S. economy is a car barreling down the highway, okay, and it sees a traffic jam up ahead. You have two options in your car, right? You can just take your foot off the gas. Right? Just take your foot off the gas, or you can slam on the brake. And what the Fed is doing every time they have these meetings is they're determining, are we just going to take our foot off the gas? And that's a lot of like when they leave rates alone.
Yeah.
Okay. They're just taking their foot off the gas. They may make some commentary that they know has some market impacts just to kind of ease off the gas. When they are changing rates either up or down, that is them slamming on the brakes. So They see something up ahead and they're going to slam on the brakes in sort of anticipation of it.
Yeah. And what the theory behind it is, as they raise interest rates, they're trying to cool inflation, right? So they're trying to say, okay, we want less money to be cycling through the economy because we do that by making things more expensive to borrow. So people borrowing less, that generally means we're investing less in businesses, we're having more trouble buying homes, as everyone can see now. And then when they drop the interest rates, they're trying to stimulate the economy. So that's typically, they do that during recessionary times. And when things are bad, they tend to do that. And that is one of the reasons they actually did drop rates, 0.25%. So basically the news is they dropped it 25 basis points. 1 basis point is 0.01%. That means they dropped 25 basis points, 0.25%. So 100 basis points is 1%.
Correct.
Right. So now the federal funds rate is between 4 and 4.25%.
Correct.
And basically what the federal funds rate is, it's the rate that other banks borrow overnight from each other.
Correct. And that is, can we just say it one more time? It is the rate in which banks borrow from each other overnight. It is not your mortgage rate, your credit card rate, your car loan rate, any of those things.
None of those things. And we'll get into what the impact of this is, because it does impact those areas, just not all directly.
Correct.
Right. So it's just about the flow of money in the economy, really. I'll give you a little rate history. Where's my little sheet?
You put it on the ground. I did. For those watching on video.
Yeah,
it's on
I know.
the ground.
All right. So basically in 2022, the post-COVID, the Fed funds rate was between 0.25% and 0.5%. Hence insanely low mortgages, right?
Correct.
Then inflation hit. Hit as high as 9.1%. So Fed's like, well, we got to slam the brakes.
Slam. And
Big
that
hard
was
slam.
like a slam. And we've slammed twice, right? So we slammed in 2020 and then to lower the rates. And then we slammed again in like 2022 to raise the rates.
Yeah. So basically, by the end of 2022, the rates went from 0.5% to 4.25 to 4.5. Right.
Huge.
And then they continued raising through 2023 up to about 5.5%, the peak. Right. Last year, they cut down 50 basis points. And then that was last September. And then finally, another year later, they dropped it down last week to another 25 bips. So right now, it's between 4 and 4.25%. So still much, much higher than even 3 years ago.
Correct. But historically, not crazy high.
No, still not crazy high. So it's enough to definitely slow the economy down. I think one of the things that they're kind of talking about is there's a couple of worries they have. There's still some inflation worries. That's why they've been a little reluctant to cut the rates earlier, as so many people are calling for, including one very important orange man. And then, now they're saying, okay, unemployment's starting to creep up a little bit. So that's a worry of ours. But we think inflation's kind of not as crazy as we think it is. So we're going to drop rates a little bit because they're trying to balance that act between inflation and unemployment.
Yeah, because you have to remember that like inflation and unemployment are almost a little counterintuitive to each other. And so that's some of what they're dealing with, is that when you sort of ease one, sometimes it impacts the other, and they're trying to balance these two things out.
Yeah, and remember, they only have the two tools. So it's not like, hey, whatever they do is going to solve the economy or do that. Right?
Correct.
So I think that's a good primer on the Fed funds rate. Now, like everyone's like, okay, cool. How does that impact me?
Well, do we want to? Who are the feds? Are we going to talk about that at all?
I mean, yeah, I guess if you want to dig into that.
Who are these people? Are they elected government officials?
No.
Are they appointed government officials?
Yes.
Yes. Who appoints them?
The president.
The president. So one of the sort of misunderstandings about who the Fed is, and who, especially specifically Jerome Powell, more than anything else, is the Fed actually operates sort of outside the bounds of the federal government. So while we call them the Fed, they're not actually the Fed.
No. I mean, yeah, they're definitely supposed to be agnostic.
Yeah.
Yep. And they also have different, I'm totally blanking on the term right now, but not divisions, but like they have different sectors. Like there's a New York Fed, there's a San Francisco Fed. So they have all these
divisions.
Kind of small, they're not divisions. I'm so mad on myself for not knowing this right now. They're not, but we'll call them divisions for now. They have all these different divisions, right? And then there's the one figurehead, which is Jerome Powell,
Jerome
right?
Powell.
So they basically all get together for these meetings. They discuss what's going on with the economy, and they all vote on should they raise interest rates, keep them the same, buy more stuff or more bonds or not. And they have these meetings once a month typically.
Correct. And the Fed, while they are appointed by a president, it's not supposed to be based on political party, on political ideology. It is really supposed to be based on the U.S. economy. And they also operate semi outside of the bounds of the federal government. Is even though they're appointed by a president, they really aren't supposed to be fired or anything like that by a president.
Yeah, they're supposed to have their terms and run through their terms.
Exactly. So it doesn't really matter if a current sitting president does not like them. It's really not supposed to have an impact on them. There is some debate on that at the moment, if that's really the case. But generally, they're sort of left alone to do their thing.
Yeah, exactly. So that's kind of who the Fed is. All right, let's get into the consumer. So why don't we talk about the smaller stuff first, like auto loans, credit cards. So those are more directly tied to the Fed funds rate. So especially auto loans, you'll see a change quicker with that. Mortgages, on the other hand, Kelly, I'm sure you can educate all of us on this. Mortgages are 100% based on the Fed funds rate, right?
Yes. Legitimately, I got phone calls this week like, hey, rates have dropped to a 4.5 or 4.25. I'm ready to refi. Because a lot of people do hear this, oh, interest rates have dropped. That means mortgage interest rates. There are lots of interest rates in the economy. There's interest rates for lots of things. The mortgages are one of them, but we're more tied towards the
10-year treasury.
10-year treasury. Derek, what is the 10-year treasury?
So it's just a denomination of debt that the government gives out that's based on a 10-year rate, like holding a bond for essentially 10 years of government debt. So it's what it really looks at more than the Fed funds rate is a factor in it. It's not nothing. But it also looks at, okay, what's our liability? So think like you're a borrower. Do you have good credit or bad credit? Do you have a lot of debt? Do you have a little bit of debt? So it's going to factor all of that stuff into it. Our debt has increased, as everyone knows. So that's why the rates for the 10-year treasury are a little higher than they have historically been.
Yeah, 100%. The other thing that probably has a bigger impact on mortgage rates than anything else, though, is sort of what the banks currently have sitting on their portfolios, right? What banks currently have sitting on their books. As I lose my voice, apparently, that's how disturbed I am here talking about this. No, I'm just kidding. Is they also have like a book of business that they are looking to either increase or decrease. And so there is a spread associated with mortgage rates versus the 10-year treasury that sometimes is not like when we see what the bond rate is and you try to equate that to an actual interest rate, there's not always like, oh, if the bond is at this, then the rates are this. It doesn't really work that way.
No.
There's kind of a lot of stuff in the middle there. It's complicated, and it's not.
Yeah.
People just want to know like what is going to make interest rates go down. It's so many things.
Well, I think the one thing this is, because I was looking at these charts because I love charts. The spread between the 10-year treasury and what the actual mortgage rates are is one of the highest it's ever been.
Correct.
And the main reason for that is banks know and mortgage companies know you are going to refinance.
100%.
So they are building that in to their costs, essentially.
Exactly. And that's one of the biggest things that's hard for people to understand. And even honestly, mortgage loan officers, it's tricky for us because again, we see a bond number and we go, oh, okay, when it's this, then the rate is this. And that is not the case right now because all of these banks have all of these loans sitting on their lines, sitting on portfolios that they're collecting interest on. And frankly, they're collecting a lot of interest on it.
Yeah, they want to keep that going.
They want to keep that going. So if we saw this happen in 2020, where rates went from here to here incredibly quickly, the rush of refis was just pouring into the mortgage marketplace, and banks lost a lot of money at this point, both from the fact that they were making more right on these higher interest rates, but also people were exiting their lines.
Yep.
Because when you refi, you don't really care who's holding your mortgage, right? So if you have currently your servicer is right, mortgage company A, and mortgage company B is offering you a better deal, you're going to go with mortgage company B. Well, now mortgage company A has lost a loan that was supposed to be a 30-year term. So they expected you to pay out on it much longer. But in reality, maybe you only bought that house a year before. So they are losing money on that loan. So they don't want to do that. So banks have now seen that happen in real life in 2020. And they're like, we don't want this to happen again. So they are going to be a whole lot slower because they want to sort of slow that crush of refinances so it doesn't really negatively impact banks.
Right. And, you know, just at the end of the day, they're trying to make money and do what's best for them. So, you know, they sell these mortgages off all the time and they're not always necessarily holding the note.
Yeah. And banks are not benevolent organizations. I always kind of I'm theoretically a mortgage banker, but banks are not benevolent organizations. They're not like, these are not nonprofits.
Yeah.
They are here to make the dough.
Yeah. And they know, like, I mean, they knew this was a temporary kind of spike with the interest rates. The inflation was going to be going on at 9% for 30 years, right? It wasn't the 80s.
Yeah.
So they had a much different view of what's going on and what to look ahead. So, well, while we're talking about refinancing, all right, so now the rates have dropped probably a little bit, and I'm sure they're going to cycle through, right? So they're talking about more rate drops coming in the future. They're talking maybe as much as like 75 basis points by the spring of next year. When does it make sense to refinance? Because I read, once you have a 1% differential on your mortgage.
Sure.
Does that make sense?
Okay, so yes, and a whole lot more goes into it than that. How do we know when it's time to refi? I will tell you my little quick primer on a refi. There are three things. Number one, right, you do want your interest rate to drop. How much does it need to drop? The larger your loan amount, the less it needs to drop to see a big impact. Okay, because you're paying interest over a bigger amount.
Right.
Therefore, you see a bigger savings. The second piece that can come into play with refinancing your mortgage is, can you move loan programs? So are you in an FHA mortgage, Federal Housing Administration mortgage that has permanent mortgage insurance and you want to drop that, go to a conventional loan, which has mortgage insurance that eventually falls off, may be a great way to do it. And the third way is, has the equity in your house increased enough to remove mortgage insurance potentially altogether? The vast majority of first-time homebuyers have mortgage insurance these days. And it could be, maybe it's $150 a month. So maybe when you refi, maybe it's only dropped a half, but you're going to save $100 from your mortgage insurance and $150 from the rate dropping. Now you're at $250. Well, wouldn't we all like to have another $250 a month in our pocket?
Right.
How do you know when it's time? You need to talk to a loan officer and they need to run the numbers. What you're looking for is what is called a net tangible benefit, which is essentially like, what are you actually saving on this after closing costs, attorney's fees, everything comes out of it. What is the savings over the length of time you think you're going to stay in your house? That's a big pet peeve of mine. A lot of lenders will be like, you're going to save $150,000 over the life of your loan. It's a 30-year mortgage. You going to stay in that mortgage for 30 years?
Yeah, most likely not.
Probably not. So we have like a discussion. Like, I like to look at 7-year paybacks. Yeah. What do we look like after 7 years? The average home buyer owns their house for 7 years. I think it's a pretty good number. But it is not as simple as everybody wants like, when rate, and I get people that say that to me, like, call me when rates hit 5.5. And I'm like, why? Why is that your magic? Have you done the math to see that that's your magic number? No, they have not. But a good loan officer will do that math for you.
And then, the other kind of wrinkle too, personal, but credit score changes.
Correct.
That goes into it. But why don't we get a little of the closing costs? Because I think that's one thing people don't really necessarily realize. Like, it's not free to just change your mortgage. Like no bank's like, hey, I've got to pay this other bank off so I can get you a new loan. I'll do that for nothing.
And every lender that tells you this is a no closing cost refinance is full of baloney.
Because they wrap it into the mortgage.
It is wrapped into the mortgage. It's baked in there somewhere, either into your interest rate, your closing cost, something. So it's in there. There's no such thing as not paying for a refi because people have to get paid to do that work.
Yeah. I mean, there's money's moving around, right? So there's got to be a cost. Now, how does that compare to the cost of a regular mortgage? Like, let's say I'm buying a home versus the closing cost of refinancing.
Frankly, not a whole lot different. Truthfully, when you are buying a purchase, right, a regular house, you're generally paying closing costs from 3 buckets. Okay. Bucket 1 is the cost to get the mortgage. Okay. That is underwriting, processing, an appraisal, your tax transcripts, your credit report. That is the cost to get the mortgage. That's really the only thing that changes lender to lender. Okay.
That's essentially the admin fees of it.
That's the admin fees. And truthfully, they're very low for most lenders. Like we're talking a couple $1,000s for like a lot of people to get paid on the work that they're doing. So that's sort of bucket 1. That exists whether or not it's a refi or a purchase. Sometimes a refi can be a little bit lower. You don't always need an appraisal in a refi. It depends on your file. And there are some times where like other things come in a little bit less in a refi, but they're generally close to the same. The other 2 buckets are called prepaids and escrows. And these are the ones that do change from a purchase to a refinance. So you have an escrow account. Almost everybody has an escrow account. Quick primer, what's an escrow? Escrow is your taxes and insurance being held in a bank account by the bank so they can pay those bills when they become due. Why would the bank do that for you? Because they do not want your house to burn down and you to not have insurance. And they do not want the town to foreclose upon you for your measly $5,000 tax bill when the bank is on the hook for $300,000. So they collect it and then they pay it. When we are starting an escrow account, a certain amount of money needs to start in that account in order for those bills to be paid on time, because they're not just paid like, oh, you can pay it whenever enough money's in the account. They have set due dates. So we have to collect a certain amount of money. When you are refining a mortgage, you almost always need to restart your escrow account. Okay, so they're going to have to collect the right amount. However, whatever's sitting in your escrow account from your prior mortgage is going to get refunded to you. So it's not lost money. It's almost just like a transfer of money, but that is a closing cost. And then prepaids are things like homeowners insurance, and there is some tax associated with that as well. But those are much higher in purchase transactions, because in a purchase transaction, you're often also paying a seller back for things that they have paid for, like a prorated tax bill or prorated water bill. Those don't exist in a refi. So it's really, there's 3 buckets. 2 buckets are important. 1 bucket is not. But truthfully, almost everything kind of washes out with the exception of the actual cost to get the loan.
Gotcha.
So that's really what we care about.
All right. So just to recap, that kind of piece of it is talk to your lender.
Talk to your lender.
Run the numbers. Don't just assume like, hey, the rates are a little lower. Let me just jump in and dive in. Because you got to look at a few factors: your credit score, how the rates are looking, how they're going to look in the future, how much equity you have, all that fun stuff.
Yep.
Right?
And
Cash
any
flow, how long you been in
lender
the house.
that tells you there's no closing costs, you're paying closing costs. You just don't know what they are.
They're wrapped into the mortgage.
They're wrapped in somewhere.
All right. Should we pivot to the investing part of this?
Yeah.
Okay.
Let's do it.
All right. So there's good and bad to this, right? Like everything in life, you know? So the bad, let's say you have a high yield savings account. Everyone's been getting 4 or 5%.
It's been great.
It's been awesome. It's like free money, right?
Free money.
That's going away. That goes away very quickly. Those drop pretty much immediately, like in line with that. So if you've been used to getting 4.5% on your high yield savings account, you're not going to get that moving forward. It's going to drop. So that's one negative. But the flip side of that is typically, okay, well, there's a thing called TINA. I don't know if you heard it. There is no
what is that?
There is no alternative, right? So a lot of people say, well, if I'm getting such a low rate on interest, it's got to be, I may as well just invest in stocks because I'm basically getting nothing. So that was basically most of 2000s and 2010s. Interest rates were so low. More people were pushed to stocks. Bonds were earning very minimal amounts of yield. So a lot of people were pushed into the stock market. So people automatically assume that the Fed cutting rates is good for the market. One of the things you really want to look at is like what kind of economy we're in, right? So Fed usually cuts rates for a couple reasons. Either we're kind of just slowly easing down, the soft landing as they call it, which is what we're in today, or we're in a recession. Oh crap, we got to slam on the brakes and juice the economy. We are not there. So generally when we're in a recession, the stock market's also gonna be just terrible. We're not in that environment. So don't want to have investing advice here, but the assumption is that we're going to have a decent return. This should be decent for the stock market. Also, it impacts small caps. So small businesses, they tend to lend or borrow more, when you're borrowing more and the interest rates are higher, they're going to have lower profitability. So with lower interest rates, that should be a boon for the smaller cap companies.
Yeah.
And the other thing to really look at is bonds. So what happens with bonds?
I
Do
don't
you
know
know?
what happens with bonds,
Okay.
Derek. Derek likes to ask me these sort of questions. I don't know.
I don't know.
I don't have any idea.
All right. Well, so cutting rates are actually good for bonds,
Okay.
right? Because let's say I've got a loan right now or a bond that's paying me 5%. Now the rates are down to 4%. Which bond are you going to want to have?
The old bond.
5%, right? So the value of your 5% bond is now worth more.
I think we talked about this in another episode, right? Because this is sounding slightly familiar to me.
Yeah, it's coming back.
Yay!
All right.
Hopefully it is for you too, listeners.
Yeah. Well, so this should be a decent environment for bonds, especially if you had the longer term bonds that had locked in a higher interest rate, because now those bonds are becoming more valuable as rates drop. I mean, we generally saw this in the 80s through the 2000s because we had interest rates up in the 12s, right? So you had bonds that were giving you 10, 12% rate of return. So those bonds look great when you're only getting 5. We don't have that same delta now, but we are going to see the price return along with the coupon payment that you're getting with the bonds. So at least in the short term, this should be a decent environment for bonds because, like I said, the dropping interest rate environment should be good for the value of those bonds.
Yeah, absolutely. And I think something to remember too, sort of about what the Fed is doing and how this impacts everything in general, is that while we are using, right, the Fed is using past data to make current decisions, current sort of market situations are not the same as what the past data is sort of showing.
Right.
So that's one of the really hard things for the Fed. And people are like, oh, Jerome Powell and the Fed messed it up over the last couple of years. They are always in a new situation, right?
Yeah.
Whatever the economy looks like right now, the economy has never looked like this before. And it doesn't matter if we've been in a recession, not a recession, it doesn't matter. There is some part of that scenario that is new, and they are guessing a little bit.
Yeah, you're predicting the future at the end of the day.
Yeah.
Right. So, and that's why you really don't want to pay attention to well, this is the average that happened when, the Fed rate cut happened, because I've seen 100 charts come through the last few weeks about this is what happened on a typical rate cut. Yeah, but the environment of the economy mattered much more than the average.
Much more. Well, the other thing too, and this is especially true for mortgage interest rates,
Mm-hmm.
what the Fed actually does in the meeting matters less to interest rates than what they say in their commentary. Because for this one, for example, I had people rates are going to go down, rates are going to go down. Friends, the rates are already down, because when you're locking a mortgage interest rate, you're locking it for 30 days generally, which means whatever rate that was locked is baking in what they think is going to happen in the next 30 days. The general consensus pre this meeting was that it was going to drop by 25 basis points.
Correct.
That was already wrapped into the mortgage rates. We had seen a slow decline in mortgage rates for a few weeks prior to that meeting. Now, what happened after that meeting? Rates went up.
Mm-hmm.
Oh my God. Why? Because the commentary was not as favorable for the amount of rate cuts that mortgages would like.
Correct.
Okay. So rates went up. So rates actually went up pretty decently the 2 days after that Fed meeting. How isn't that counterintuitive, Derek? Right? Fed drops the rate, mortgage rates go up.
Yeah, no, I mean that on its face doesn't make sense. But when you explain it hey, look, they're forward looking, they're trying to project out. They have what's called a dot plot where they project out, okay, these are the rates cuts are going to be at this specific time frame. They're not always accurate, but if they follow along those lines and the commentary behind it matches expectations, that's when you see nothing would change.
Yeah.
It's when the expectation is different than the reality is when you see it either a bump, either positive or negative.
Yeah. And I will say, if I can give Jerome Powell, any whatever, again, he's a love-hate guy for us.
Yeah.
He tends to cut, but then make really conservative remarks.
He does.
And so that is some of the sort of dissonance between what happens with his cut and then what happens to rates, is that he'll be like, we cut and I don't think we're going to do it again. And everyone's like, oh my God. And then rates spike back up again.
Yeah. And, in fairness, there's a few, two things that are really, they're paying attention to, based on their two mandates that are really impacting this, right? So one is the inflation part of it. We don't know what the full impact of tariffs are. They're kind of moving around. It's a moving target. It's hard for him to say, okay, this is exactly how we know what's going to happen with tariffs. We just don't know because they change all the time.
Well, and there was just
there's a huge lag.
Trump just had a meeting with Great Britain to discuss tariffs. What could that do? We don't know.
Yeah,
we don't
know. Yeah, we have no idea. And then the other piece is the unemployment piece, right? So if that keeps ticking up at a faster rate than he thinks, he's going to have to step on the brakes harder.
Yeah.
Right. So that's That's something we just don't know. Like the trend is unemployment is going up. So more and more people are losing their jobs. But it's still not at a level where like, oh my God, I got to worry about it. Like 2008 unemployment rate was almost 10%. Now it's at 4.2.
Nowhere near
something,
that.
right? We're very far off that. But that's just something to keep in mind because it's not just going to be, oh, this is happening right now because of this, this, and this. It's a moving target all the time.
Well, and that's the other point about sort of the dot plot is that the dot plot, right, is forward looking. It's looking at the future. There is also political things happening parallel to the timing on this dot plot that the Fed cannot predict for. Right.
And they can do nothing about it either.
And they do not, because again, they're not political. They're not privy to this information. When tariffs sort of became a big thing this year, they knew the information at the same time we, the public, did. So they're making these guesses, but then there's other things happening. So they have to adjust according to what has already happened based on what they thought was going to happen. So it can be really tricky, right? And I will say, non-politically, we've had a tumultuous year in sort of never before seen things happening, new things happening, political things happening that were unknown to the Fed at the time.
They're just so different than the norm.
Exactly.
Right.
The other just quick note on interest rates as well. Mortgage interest rates also are affected by large events. Okay. Things like COVID, things like wars starting, things like wars ending, things like natural disasters. So anything that sort of causes a disruption can have an impact on the bond, which then has impact on mortgage interest rates. So that's hard too. Like truthfully, when Ukraine and Russia went to war, there was some big shakeup in interest rates that week. And that's hard to tell people like, hey, a war happening, not in the United States, actually having nothing to do with us, has an impact on you buying a house here in Connecticut. It 100% does. And that's like another kind of layer to the whole thing.
Yeah. Well, I think the last question we should probably go through is, all right, so rates are dropping. Housing can be more affordable, right? 100%.
Yeah. No. Okay. So will houses be more affordable? Your current house that you purchased may be more affordable. Okay. Because you can refinance it if you had a high rate. If you are hoping that the house that you are buying is going to be more affordable, that remains to be seen. So there is sort of two scenarios that can happen. Scenario one is that unemployment stays the way that it is, right? So relatively low. So people can buy new houses. Interest rates drop. They think, housing is more affordable. And lots of new buyers rush into the market. And this will drive the sale price up. This is exactly what happened in 2020, 2021. And 2022. And this is why the value of homes has increased so dramatically since that time, because so many people rush into the marketplace. Now you've got a house listed for $500,000, 40 people have made offers, and it's going to sell for $650,000.
Well, you could throw an extra $50,000 in there because it's only $50 more a month.
Yeah,
it's
it
like,
doesn't
I can
change
afford
a lot.
that. Yeah.
So that's sort of scenario one. That this is going to happen. That will actually make housing probably slightly less affordable. Scenario two is unemployment starts to rise. Okay. That means people in current homes can afford them less. They may sell their houses. Okay. Therefore, landing more inventory on the market. I don't think that's going to necessarily drive prices down and make things more affordable, but it might actually just level things out a little bit. There also is a midway between these two. Okay. Which I actually think is probably our best case scenario is like inflation goes up a little. Oh my God. Unemployment goes up a little bit. There is more inventory coming on the market. Interest rates come down a little bit. And we are sort of hit more of like a homeostasis. It's actually been getting closer to that here in Connecticut. Not everywhere. We're actually seeing in some parts of the country, like Florida, where we are sort of seeing a lot of inventory come on, prices drop dramatically.
Some are like 25% I've seen.
It's been big. But like here in Connecticut, that's not really been the case. All we're really looking for is like homeostasis.
But those have been more insurance driven because the insurance costs have gone so far up.
It's an affordability problem in Florida.
So it's like, the price of the house dropped, but you're still paying the same because you're paying for insurance.
You're paying for insurance. And and actually you probably are paying a whole lot more because insurance has gone up so much in Florida. Connecticut is also having some insurance issues. We are one of the hardest states to insure in right now. People don't really know that.
Well, the whole roof thing. We're not
the whole roof thing. Hail. I don't know. I could tell you the whole thing. But we're kind of still stuck a little bit in that higher range where we're still seeing a lot of offers on houses. We're still seeing a lot of lovely millennials that are stuck in our tiny first homes that we thought we'd be out of now, because we have a 2.75% interest rate. We ain't going nowhere unless we lose our jobs and can't afford our house anymore.
Well, I think that's what people don't realize. The trade-off is, do you like your job?
Yeah.
Would you rather pay a little bit more for a house, or would you like to pay less for a house and lose your job?
Correct.
Because that's basically the trade-off we're looking at here. Because in order for houses to really drop in value, unemployment has to go up a pretty significant amount.
Yeah.
We can't just sit there and say, okay, well, it's just going to drop.
Something is going to change it. Yeah.
Unless home builders start building 10x the amount of houses they're building, which why would they? Because then they know the value of the house they sell would drop.
Yeah.
So,
and I think the people, well, what happened in 2020? 2020, we were just dealing with all unprecedented things.
Yeah.
So should the Fed have lowered the rate to where they did in 2020 and 2021? Hindsight's 2020. No, they should not have.
The government should not have given as much money. They shouldn't have lowered the rate
Correct.
so much.
But
It's just too much.
they didn't know that at the time.
Well, one of the big lessons from 2008 that everyone kept saying was like, we just didn't do enough.
Yeah.
So then they were like, well, let's do a lot. And there was too much.
Too much. Yeah, there was too much. And it not only was it too much, but it happened too fast.
Yeah.
It was just all of this stuff was dumped into the economy to save it. But we weren't waiting for the economy to like sort of slip.
Yeah.
We were just artificially dumping into it.
Yeah.
So it was a little bit tricky. So we are not in that case. That scenario, hopefully, should never happen again. Because we've learned lessons again, which is what happens over time. But that was a really unprecedented time for everyone, for unemployment, for the economy, for the housing market, for interest rates. If you guys remember back in those dark days, those of us who were working from home with our children because daycare was closed, it was very unprecedented.
Yeah. The amount of times when daycare opened back up, I had to take them back in because some other kid had COVID.
Correct.
It's insane.
I had a quick side note. I had 2 kids in daycare in 2 different classes, and they had 10-day quarantines if they were exposed.
Yeah.
And I had 1 kid on a 10-day quarantine. Okay. So I'd missed 10 days of work. I'm dropping her off. And then we get the notice that my son's class now has a 10-day quarantine. So I had to pick him up out of his room as I dropped the other kid off and stay home for another 10 days. So 20 days in a row.
I think I calculated one year. I think it was like 22. We lost like 6 weeks of work.
Yeah.
Due to that. Just that.
It was wild.
Yeah.
It was wild. So hopefully that never happens again.
Hopefully not. All right. Why don't we give a quick recap, and then unless there's something else you want to
Jerome Powell, we love him. We hate him, but he's doing his job.
Hey, he's doing what he's got to do.
He's doing what he's got to do. We don't always know the methodology, but like, he's trying. The man is trying.
Yeah. I'd say recaps from an investing standpoint, watch your high yield savings account, discuss, okay, does it make sense to keep as much cash as I have now available? Maybe you look at alternative investing to get more yield, depending on your situation. I think from the mortgage standpoint, talk to a mortgage broker. It's going to be situational based on your time frame and all that stuff. But they're also talking about dropping rates even further. So it may not be like the best time to jump on that right now. Correct.
It really depends on your situation. I will just say as sort of a blanket for people, if your rate is currently over a 7, it may not be time for you to refi yet, but you should be engaging in a real live person, real live mortgage loan officer, not the internet where you've plugged numbers in, because they're just going to tell you that, oh yeah, this works.
Well, because you're also allowed to talk to a mortgage broker and not actually buy a house for a while. Like that is a thing that you can do.
I have a bunch of clients right now that are like on notice that I use a program that scans their loan every day looking for these sort of rate drops. But I have a whole bunch of people on notice that we're communicating like every 2 weeks, like I'm watching, we're still not there. And they'll reach out, are we there yet? We're still not there. But yeah, you can kind of engage in this for quite some time. And that is part of what a good loan officer is doing is they are like watching your stuff for you.
Right. So that's it. I would say just talk to your professionals.
Yeah, as always. That's the message in the podcast. Yeah. Talk to your professionals.
And then, if you like the podcast, tell some people about it maybe.
Yeah, let us know. We've got ideas. You want to hear a topic.
Yeah,
we would love
to hear from you. All right. See ya.